If I could go back in time and give my younger self one piece of money advice, it would be don't leave your money sitting in a savings account, invest it. Because here's the thing, when your cash is sitting in a savings account, it's actually losing value over time due to something called inflation. You might think that it's a smart or safe move, but think again. Every single year, prices go up, portions get smaller, and the same amount of money will buy you less and less. I'm aware that investing can feel super overwhelming, there's a lot of jargon, a lot of options, and you might feel like there's so much you need to learn, but it doesn't have to be that way. In today's video, I'll be sharing my ultimate beginner's guide to investing and how you can get started today with as little as $50 using my favorite app, moomoo. We're going to cover off what investing actually is, the magic of compound growth, smart investing for beginners, what to buy and what to avoid, a simple step-by-step plan, plus a few tips and tricks that I wish I knew earlier to help you build your wealth faster and smarter. Let's get straight into it. Alrighties, so let's start with the basics. What exactly is investing and why should you care? At the end of the day, the point of investing is to turn your money into more money. If you've got $1,000 sitting in a checking account, you could just leave it there, or you could go ahead and buy yourself the new iPhone 17. But the reality is over time, that money is slowly losing its value. You might be thinking, but my high yield savings account gives me 4 to 5% of interest every single year. Does that not count? Not exactly. It's perfect for your emergency fund or for your short-term goals, but here's the thing, despite your balance going up month on month, your high yield savings account isn't actually growing, it's just keeping up with inflation. Investing, on the other hand, is like sending your money to work for you. You're putting it into assets like stocks, bonds, or real estate that have the potential to increase in value over time way more than your savings account will. Yes, there is more risk, but there is way more potential for long-term growth. So how do you actually grow your money? Compound growth. Let's say that you invest $150 per month. That is $1,800 in 1 year. Fast forward, by year 5, you'll have put in $9,000, but your account is now worth more than $11,000. By year 20, you've invested $36,000 of your own money, but your balance has snowballed to roughly $75,000. This is why investing matters. It's not just about protecting your money from inflation, it's also about letting time and compounding grow your wealth. And while there are lots of things that you can invest in, like real estate, bonds, crypto, or even collectibles, in today's video we're going to be focusing on the stock market. The reason is simple, there's a very low entry barrier and you don't need a lot of money to start. Now that we've talked about what investing actually is, let's move on to the fun part, how to make money with investing and what I recommend you buying as a beginner. Whenever you buy a stock, you're basically buying a tiny slice of ownership in a company. So imagine you've bought some Tesla shares, you literally own a very, very small percentage of the company. And because Tesla is a publicly listed company, anyone like you or me can buy or sell their shares. But we can't just walk up to Elon Musk and ask for shares, we have to go through a broker. In Australia, most brokers are CHESS sponsored, which simply means that the shares you buy are legally registered under your name and not the brokerage platform. Personally, I use moomoo for all of my investing, and they're actually the most downloaded share trading platform in Australia in 2025. Their app is easy to use, has a great user experience, and they offer very low brokerage fees, and they also have great new user promos that we'll go through in a sec. Now you might be wondering, well, investing sounds great, but how do I actually make money? The first way is buying low and selling high. This is when you're hoping the share price goes up over time so you can sell for a profit. For example, if you bought 10 shares of something at $200 each, that is a $2,000 investment. If the price later rises to $400, selling those same shares would give you $4,000 back. That is a $2,000 profit just from the stock price increasing. Now, the second way to earn money through investing is through dividends. Some companies pay a portion of their profits back to their shareholders in the form of a dividend. Now imagine if a company pays a $5 dividend per share, and given you own 10 shares, you would receive $50 in dividend payments. That is basically free cash landed in your bank account just for holding the stock. So now that we understand compound growth and how to make money while investing, the question comes down to, how do you actually pick what to buy? Here is my honest advice. Unless you have a super high risk tolerance, just stick with ETFs. When I first started dabbling in the stock market back in 2018, one of my close friends suggested I purely buy ETFs. I refused to listen. I thought he was too boring and I wanted the adrenaline rush of buying low and selling high. So I tried to stock pick individual stocks. Of the 10 stocks I bought, 9 of them completely crashed and I lost about 90% of my money. And that is why these days I've learnt my lesson and I purely stick with ETFs. They might not be as exciting or give you that adrenaline rush, but they are definitely way more reliable and rewarding over time. So what exactly is an ETF? An ETF stands for an exchange traded fund, and it's basically a basket of stocks bundled together. For example, the S&P 500 ETF invests in the 500 biggest companies in the US. Instead of betting on just one winner, you are essentially investing in all of them. And if one company drops, your portfolio doesn't take a huge hit. Here in Australia, a popular ETF is called VAS, which tracks the top 300 companies listed on the Australian Stock Exchange. So when you buy VAS, you're basically getting exposure to all 300 companies without needing to buy them one by one. So for example, approximately 10.91% of VAS is in CommBank and 7.31% is in BHP. So to put this into perspective, if you had invested $1,000 into VAS, you would own approximately $109 worth of CommBank and $73 worth of BHP. And the best part about investing, you don't need a lot of money to begin. Platforms like moomoo make it so easy to invest, research different ETFs, and even set up recurring investments so you can automatically grow your portfolio. Trades start from just $3 for Aussie stocks and as low as 99 US cents for US stocks, excluding foreign exchange fees and third-party costs. I honestly cannot stress how cheap these trades are. I used to use Westpac's share trading platform because I worked there and I didn't know any better, and my brokerage was around $20 per trade, meaning that every time I bought and sold something, I was losing $40. And given that I'm buying in pretty frequently into the stock market, switching to moomoo has saved me so much on brokerage fees. Personally, I really enjoy how easy it is to compare different ETFs side by side. So here I've got VAS, an Australian ETF. I can check its top holdings, past performance, dividend payouts, and management fees all in one place. And let's say that I was curious about the S&P 500, I can also add that in and use moomoo's ETF research tool and compare the two. And if you're thinking more long term, moomoo also has you covered. They have an option for recurring investments where you can invest a set amount on your schedule, whether it's once a fortnight or once a month. So if you're just getting started, ETFs are one of the simplest and safest ways to begin investing, and apps like moomoo make it so easy and affordable to start. Let's now move on to a step-by-step plan to help you buy your first ETF. Step 1 is a checklist. Make sure your foundations are solid, that you've paid off any high interest credit card debt, and that you have a bit of an emergency fund saved up. Step 2 is to choose a brokerage platform. Now there are banks in Australia that do this, whether it's CommSec or Westpac Share Trading, but their trades are really expensive. That is why I use moomoo, and it really does tick all of my boxes when I'm looking for a brokerage platform. Account setup only takes a few minutes, and once you're ready, all you've got to do is transfer some money over from your regular bank account into your brokerage account, and you're ready to make your first trade. You can either specify a price you want to buy a stock at, or you can put through a market order and it will get bought at the next available price, and this is what I recommend doing for ETFs. Now we wait for our order to go through, and there you have it, you now own your first ETF. Let's now build the habit. We've got to pick a contribution that we can sustain, whether it's $50 or $500 every single month, and automate it. Now this is called dollar cost averaging, where you buy in small consistent amounts over time and rely on compound growth to grow your wealth. My biggest regret is not starting earlier. Before we wrap up, I want to touch on one more concern that a lot of people might have, and it's, what if I lose all of my money? Short-term dips in the stock market are completely normal and it's nothing to be afraid of. In fact, if you're investing in ETFs, just know that the market will always recover in the long run, and it's something that I wish I knew sooner. I definitely learned this the hard way. Back in March 2020 when COVID first hit, I panic sold all of my VGS at $72 a share. At the time it felt smart because VGS continued to drop to $68, but I never bought back in. Had I just held and didn't panic sell, VGS is now worth more than $150 per share and my investment would have doubled. These days, when the market drops, I treat it as a shopping day and a chance to buy in at a discounted rate. And finally, to round up our beginner's guide to investing, we have to talk about taxes. Because yes, the ATO does know when you make money from your investments. You might have heard of something called capital gains tax, which is the tax you pay when you sell your stocks for a profit. Going back to our example, let's say that you bought 10 shares at $200 each, and then you later sold them at $400 each. You've now made a $2,000 profit. Now this $2,000 profit is going to be added into your taxable income, and you'll have to pay tax on it at your marginal tax rate. Now here's a bonus. Let's say that you held the stock for more than 1 year before selling. You actually qualify for a capital gains discount, meaning that rather than paying tax on $2,000, you only have to pay tax on half of that, or just $1,000. Dividends are also added to your taxable income in Australia, although most Australian companies do include franking credits, which offset the tax already paid by the company, meaning that you won't be double taxed. Now that you know all about investing and how to get started, it's now your turn to take action. If you're looking for a brokerage platform, I honestly couldn't recommend Moomoo more. They really do make it so easy for any beginner to get started with their low brokerage fees, intuitive user experience, and also research tools available. And if that's not enough incentive for you to try them out, they are offering a super juicy sign-up promo right now, where new users can get up to 38 free shares, as well as $0 brokerage on both US and Australian trades in their first 30 days. Thank you again to Moomoo for sponsoring today's video. I will have them linked in my description box below. I highly recommend you checking them out, setting up your account, and beginning your investing journey with as little as $50. I hope that you enjoyed today's video, and as always, take care, stay safe, and I will see you in my next one. Bye!